In Forex, most beginners think strategy or indicators decide success, but the real game changer is position sizing. It decides how much you risk, how long you survive, and whether you trade safely. Without it, even strong strategies fail. Today, let's uncover the beginner's guide to safe position sizing. Position sizing simply means choosing how large or small your trade should be. It's not random, it's risk control. This guide will break down position sizing in the simplest way possible, showing beginners how to protect their accounts, trade safely, reduce unnecessary losses, and build long-term consistency in Forex. Point 1. What is position sizing? Position sizing is deciding how much of your account to put into a single trade. Instead of guessing, you calculate the right trade size based on account balance and risk. For example, two traders with $1,000 accounts can trade very differently if one risks 1% and another risks 10%. The second trader is far more likely to blow the account quickly. Position sizing isn't about chasing large profits, it's about survival. It acts as your shield against big losses. Without correct sizing, even a profitable system can collapse. With it, you stay disciplined, protect your account, and give yourself the chance to succeed. Point 2. Risk. Per trade explained. The golden rule in Forex is clear. Never risk more than 1% to 2% of your account on a single trade. That means if your account is $1,000, the maximum you should risk is $10 to $20. Beginners often ignore this rule, risking 10% or even 20% in one position, and one bad trade wipes them out. By sticking to 1% to 2%, you ensure you can survive losing streaks and still have capital left to recover. Even professional traders face losses, but controlled position sizing keeps them safe. Trading isn't about winning every time. It's about managing losses so no single trade destroys your journey. Point 3. Calculating position size with account balance. Position sizing follows a simple formula. 1. Decide your risk percentage, AGIs 1%. Multiply by account balance, 1% of $1,000 equals $10. Divide by stop loss distance. If your stop is 50 pips, $10 divided by 50 equals $0.2 per pip. Match pip value with lot size. A micro lot equals 10 cents per pip, so you trade 2 micro lots. This way, every trade stays within safe limits. Beginners who use this calculation avoid emotional trading and guesswork. The math is simple, but the result is powerful. It ensures consistency, discipline, and safety. Everything beginners need to survive and grow in Forex trading. Point 4. Using stop loss with position size. Position sizing means little without a stop loss. A stop loss is the level where your trade closes automatically if the market goes against you. Combined with position size, it guarantees your risk stays controlled. For example, if you risk $10 on a $1,000 account with a 25 pip stop, each pip should equal 40 cents. That way, the maximum loss is always capped at $10. Without a stop, one trade could wipe out weeks of gains. Beginners must always place a stop, then size the position around it. This habit protects capital, removes panic, and creates consistency. Safety in Forex starts with this partnership. Point 5. Beginner tips for safe trading. Safe position sizing is about discipline, not excitement. Here are 5 tips every beginner should follow. 1. Always set a stop loss before entering. 2. Stick to the 1% to 2% rule without exception. 3. Start with micro or mini lots until your account grows. 4. Keep a journal of each trade, recording risk and position size. 5. Focus on small wins. Consistency matters more than one big gain. These habits prevent over-leverage and emotional mistakes. Safe position sizing may feel slow, but it's what professionals rely on daily. For beginners, it's the difference between gambling recklessly and building a strong trading foundation. Position sizing isn't complicated, it's the backbone of safe trading. By risking small percentages, calculating correctly, and pairing with stop losses, beginners protect their capital. Mastering this simple rule ensures survival, consistency, and the confidence to trade Forex safely for the long run. If this guide clarified position sizing, hit like and subscribe to Pip My Trade. Comment below. What risk percentage do you use? Let's build smarter, safer trading habits together.